Good evening, ladies and gentlemen, and welcome to our Thursday afternoon Power Options strategy discussion for today, Thursday, November 5th, 2009. Tonight, we're going to be discussing a little bit about parity trades. We're going to be showing the comparisons between covered calls and naked puts, and some of the things that you're going to want to look out for when comparing these two types of strategies. And of course, as always, we're going to be using the Power Options tools to help us showcase some of those views, what to look for, how to compare the different positions as well. I want to remind all of you that we do have a questions pod on the technology that we're using this evening. You can use that to send me questions during the presentation. However, I am going to leave time at the end of the presentation. Hopefully tonight we'll be able to save maybe 10 or 15 minutes, but even if I go a little bit past 7 o'clock Eastern Time, I'll still leave some time to answer questions that you might have about the Power Options tools or about the presentation in general. And I recommend that you hold your questions there until the end. Simply because everyone attending this tonight will get advantage of the questions that you ask and hopefully the answers that I provide, or they may have something to add to the discussion as I'm answering your questions. So if we leave those to the end, the presentation will go much smoother and we'll be able to handle all the questions that come in. Now, before we do get started, I'm going to give, of course, a brief introduction to myself and to what is Power Options. But before I do that, I just want to remind everyone that the sample trades and example trades you see this evening are not recommendations of which securities to buy or sell. Options trading, of course, does involve risk and may not be suitable for all investors. Most of you are here because you've already been trading or you're interested in learning more about covered calls or maybe comparing naked puts because you've already been trading covered calls. And this is an educational presentation. It's not a recommendation on which positions to buy or sell. I am not a broker, nor am I an advisor. I'm an options educator. So with that out of the way, ladies and gentlemen, thank you again for joining us tonight, and let's get started. Now, for those of you who may not be familiar with our tools, you might be wondering, what is Power Options? Well, Power Options is a patented suite of search and analysis tools that was developed by Ernie Zerener about 12 years ago. These suite of tools are designed for self-directed options investors. Our tools support over 23 different option strategies. With these tools, you can search the entire universe of options in a given strategy in less than a second. Once you've identified the position, of course, you can quickly compare the risk versus reward of that position to other positions as well, or other combinations that you might be interested in. We also offer a powerful suite of portfolio tools to help you paper trade, track, and manage your positions. In addition to tracking the positions, the portfolio tools will help you with certain analysis and rollout opportunity suggestions. Again, not recommendations, but suggestions to help you potentially roll the positions and manage the positions as well. In addition to the powerful tools that we offer, we also have countless educational articles and help pages, not only on the 23 different strategies that we support, but also on the variety of tools that you can use for different analysis and research in those strategies. Of course, we've been in business for over 11 years, and we have many more years on staff of combined trading experience. My name is Michael Chupka. I am the Director of Options Education here at Power Options. I've had the great fortune of working with Ernie and Greg Zerener for the past 7 years. I handle all of the coaching sessions and a lot of the education that is on the site. I've co-authored 2 books with Ernie Zerener, one on naked puts. I'll show you that a little bit later this evening because it applies to the discussion that we're having. And also one, of course, on protective option strategies using different combinations of collars and married puts based on what kind of market you're in or what your sentiment of the stock is in. Now, I am versed in all strategies on the site and how to use the various tools for all strategies on the site, but there are several strategies that we support that I won't trade because I'm not comfortable with the risk-reward profile. Things such as short strangles and short straddles, I just won't trade them. I don't like the unlimited risk that you have with those types of positions. If I am neutral on a stock and I'm interested in maybe considering, or I should say considering a short strangle, I'd much rather do perhaps an iron condor on that position even if it's a stock. So I can help you with all of the tools and how to find the positions, analyze the positions, and manage the positions, even though I do not trade those positions. Okay. So tonight, what we're going to be talking about is the parity trades, looking at covered calls and comparing them to naked puts. Well, first, let's start off with the basics. This might be a review for some of you. We're going to go through this at a reasonable pace, not too quickly, but quick enough so that some of you won't get bored if you've been trading the positions. Okay? Start off with what is a covered call. A covered call is a very popular income strategies for stock investors as they drift into options investing. It is a neutral to bullish strategy. We typically want to do covered calls on stocks that we think are going to be staying the same or moving up in price. The action of a covered call is we're going to buy stock, and if we're doing a buy right, at the same time we buy the stock, we're going to sell a call option against those shares. If I already own stock and then I sell a call afterwards, it's just typically called a covered call. So you can do buy rights or you can do standard covered calls. Now, I'm going to receive a premium, of course, for selling the call against the shares of stock. The premium that I receive lowers my cost basis, but the call that I sold was going to obligate us to deliver shares of stock at the call strike price. Okay? The covered call position still takes on all the risk of standard stock ownership. The premium we receive may lower the cost basis by 4 or 5%, depending on how much we can get. But this means we're still risking 95% of the total capital invested in the position. We can use stop losses, we can use other techniques to protect against it, but in essence, if the stock goes bankrupt overnight, we're still at risk for 95% of the stock ownership. After we sell the call, if the stock is not trading above our strike price, the call will expire worthless, and we can continue this process to continue to sell calls against our stock and try to continue to lower our cost basis. Okay, so that's just a basic definition of a covered call, and we're going to look a little bit deeper into that. There are three main approaches, I feel, personally, for a covered call investor. And it's pretty simply breaking it down between an in-the-money covered call seller, an at-the-money covered call seller, and the out-of-the-money covered call seller. By in-the-money covered calls, I mean I'm going to buy a stock, let's say I buy stock XYZ at 50, and I'm going to sell a call below the current stock price. So if I buy shares of stock at 50, I might sell a 45 call 1 month out in time for, let's say, $6. If the stock stays above $45 per share, my stock's going to be assigned, meaning it's going to be purchased from me or called away from me. I'll no longer have the stock. I keep the $6 that I received for selling the call. But since I bought the stock at 50 and sold it at 45, I only made $1 in profit. What this means is that within the money covered calls, when I'm assigned, I potentially have a lower percentage return, but I have a higher downside protection. For covered calls trading, downside protection is defined as the option bid price divided by the stock price. On our $50 theoretical stock that I just mentioned, if I collected $6, that is going to give me a downside protection of roughly 12%, meaning the stock needs to drop 12% before I'm technically losing money on the position. But because I sold it in the money, I collect intrinsic value and time value. And that's what gives me that higher downside, but I'm also giving up intrinsic value when I get assigned. At the money covered call positions, this is where I'll buy stock. Let's say we look at our same stock, XYZ, I buy it at 50, and I sell the 50 strike call. And this obligates me to deliver my shares of stock at $50, provided the stock's trading above $50 at expiration and I perform no management. Now, this can give us potentially above average potential return and downside protection. What I mean by that is that if I'm selling the 50 call, I might receive about $2 in premium. So if the stock stays above 50, I get assigned at 50, which was equal to my stock price, and I keep the $2 premium. That's a pretty decent return on a $50 stock. I don't get to take advantage of any of the further upside unless I manage the position. However, as compared to the in-the-money covered call, we only received $1 of net income, or $1 of total premium after we got assigned, whereas the at-the-money, theoretically, might have given us $2. The downside protection is lower in comparison to the in-the-money covered call because instead of receiving $6, I only received $2. Now I'm going to show this on an option chain with a sample with a real stock in just a minute. I'm just trying to verbally give some examples. The third approach is the out-of-the-money covered call. And with the out-of-the-money covered call, naturally, we'll buy stock, but now we're going to sell a call option above the current stock price. So again, buy our shares of stock at 50. Now we might only sell the 55 call for 50 cents. We receive a very low premium, which basically gives us no downside protection or very small amounts of downside protection against our cost basis, but there's a very high potential return. Because if I am assigned when I receive my maximum profit, that means the stock's trading above $55 per share, I'll get that $5 of intrinsic increase plus keep the 50 cents, but we do have a very low probability of getting that position. All right, or getting assigned and having the stock move up that high. Let's take a look at this in a little bit more detail. To do that, we're going to leave our slide presentation for the moment. We'll come back. We're going to go to the PowerOptions suite of tools. Now, we're talking about covered calls, so first I'm just going to select the Covered Call tab, and this gives me access to all of the tools available. And we're going to go straight into the option chain, and the option chain on PowerOptions is very unique for covered calls and naked put investors because we show you on the option chain, in addition to the standard things you might see on a given chain, such as the bid price and the ask price, the option volume or the open interest, maybe the delta. For covered call traders on our chain, we show you the calculated downside protection, percent return if assigned, and the probability. And on the naked put screen, we'll show you the percent naked yield, the percent to break even, and the percent probability above as well. We're going to talk about those a little bit later in the presentation. Let's take a standard sample stock for our presentation tonight, of course. Let's just use Apple. Everyone knows Apple. Everyone watches Apple. Not everyone trades Apple. Okay, but what I'm going to pull up is just the 5-strike call chain. Right now, it is showing me the expiration for all months up here at the top of the screen. Let me just highlight that for everyone. So I have here the November, and as I scroll further down, I'll have the Decembers as well. To keep the presentation simple, I'm only going to select December. November's a little bit close to expiration. To get a better view, let's go ahead and just view the December call options. Now for this position on the 5-strike call chain, it's only showing me the 5 strikes in the money and the 5 strikes out of the money. For right now, I'm just going to focus on this little block in here, the 185, the 190, and the 195. Going back to our 3 examples that we just discussed, currently right now, Apple Computer is trading at about 194.03. Okay? So actually, I apologize, I lied. I'm going to focus on a different sort of block here. I apologize. I'm going to focus on the 190, 195, and the 200. That's what I wanted to say. And we're going to just assume the stock's at 194, but we're going to use the 195 as our at-the-money example. It's close enough to the stock price. It's the strike closest to the stock price. Even though it's $1 out of the money, we're going to refer to that as our at-the-money position. All right? Well, with the stock at 194.03, our 190 call for December is currently trading at $10.40. So if I bought the stock at 194, sold the 190 call for $10.40, this would essentially give me a break-even of about $183.60. This equates to a 5.4% downside protection. $10.40 that I receive in premium is 5.4% of the current stock price. This gives me a cushion. The stock can essentially drop 5.4% before I'm technically losing money on the position. If the stock stays above 190 by December expiration, I do no management and let the position get assigned, we could earn about 3.5% for a 44-day time period. If you're wondering over here on the far right, I do have the annualized percent if assigned annual selected, so that would be a 29% annualized return. This is the in-the-money call. So we're $4, let's just say $4 in the money. It's $4.03 in the money, but let's say we're just $4 in the money if we sold the 190 call. We're going to receive $10.40. That means essentially we have the potential of making $6 of time premium, $6.40, I should say, of time premium. That's our 3.5% return. Now, in comparison, if we look at the at-the-money covered call, this is the 195. This is out of the money, and the current bid price is $7.65. When we sold the 190, we have $4 of intrinsic value, but roughly $6.40 of time premium. As a covered call seller or a naked put seller, the time premium is our profit. That's what we look to achieve. The out-of-the-money option, the at-the-money option, the 195 at-the-money option, has a time premium of $7.65. The whole premium is time premium because we're above the stock price and out of the money. If I sold this call, I'd have a 3.9% downside protection, so slightly lower than what we saw with the in-the-money position, but my potential return if assigned is higher. I can make 4.6% maximum return. That is if and only if Apple's trading above 195 at December expiration. Now, we do have the probability shown as well. For our 190 call, we had about a 58.6% probability that we would get assigned and earn that 3.5%. For our slightly out of the money 195 call, we have a 47.9% return, and as we showed before, this would equate roughly into about a 38% annualized return. As I go slightly out of the money, we'll take a look at the 200 strike. This is about 6 points out of the money, but we have a call premium of 540. Since this is out of the money, that's all time value. So what did we just see? Our in-the-money option is $4 in the money with a premium of $10.40, so we have $6.40 of time value. The at-the-money option, the 195, has $7.65 of time premium, and the out-of-the-money now is offering $5.40. So naturally, what do we expect to see? Lower downside protection. We collected less against the underlying stock price, just the hard premium, so we only have a downside protection of 2.8%. But if the stock moves up and goes above 200 at December expiration, and we do no management, we can potentially get assigned for 6.0% return. But as we go further out of the money, we have a lower probability of earning that return. We only have about a 37.5% chance of earning that return. Another way, if we wanted to go to the extremes, let's go all the way down to the 175 call. Deep, deep in the money, about 20 points in the money. Current price is $21.45. So that means we're really only making about $1.45 in premium. This would give us a high downside protection, 11.1%, a much lower percent if assigned because we're giving up so much of intrinsic value. We bought the stock at 194, but we're agreeing to give it up at 175 as long as the stock stays above 175. So we can make 1.4%. But look, we have a much higher probability of earning that return, about an 86% theoretical chance of getting that 1.4%. To the other extreme, if we go deep out of the money, if we go about 20 points out of the money here, let's just take the 220. We'll receive a $1.08 premium. That's even lower than the $1.45 time value we had roughly in that 175 call. Again, very little downside protection, 0.6%. Very high potential return if assigned for 45 days, 14%. We only have a 9.4% chance of getting that return. The covered call that you select is going to be based on your personal risk-reward tolerance. How much downside protection do you want, and what is the minimum return you want on a monthly basis? And, of course, what is your expectation of the stock? All of these returns, if assigned, these only happen if the stock's trading above that price, above our strike price at expiration. Sure, I could make 14% on this deep out-of-the-money call, but in order for that to happen, I have to expect the stock's going to move above $220 in the next 44 days. All right, so that's our breakdown of just comparing the in-the-money and at-the-money covered calls. Based on your personal risk-reward tolerance is probably going to determine what kind of covered call seller you are. But let's take a look again at some of our examples and why one is used over the other. With an in-the-money covered call, we saw that we have a higher downside protection, slightly lower percent return if assigned in comparison to the other strikes on the chain. The common objective is usually to have the position assigned. Most in-the-money covered call investors I talk to, they're looking for new positions month by month. They're selling an in-the-money call looking for a relatively low return of maybe around 2 or 3%. That's not really that low. Sometimes some will go as low as 1.5 to 2.5% return if they're assigned. They're looking for the higher probability of getting assigned. All they want to do is have a position, let it get assigned 30 or 45 days later, take the 3% profit or 2% profit they make, and then roll into another position with the same type of criteria. Now, this does give a relatively high downside protection. You might have a 5%, 6%, 10% downside protection based on the premium you received. But remember, covered call trading and naked put trading, we're essentially obligated, we're at risk for 95 to almost 100% of the capital we invested. Okay, so there's still a lot of risk involved with these positions. Even though they're very popular and they're considered low-risk positions, you have to watch the downside. You want to use stop losses or other protective methods if you're fearing the stock's going to go against you. So we want to take profits and then enter the new positions. We can even roll the positions month by month. I've talked to various investors over the last 7 years who will start with an in-the-money call, and then once it starts to move up, they'll just buy back that in-the-money call and sell another one for the next month out. You can do that and make it profitable too, but it does take some management. Again, the risks, similar to stock ownership. The premium does reduce some of your cost basis, but you're still at risk for the entire capital invested. If by some chance the stock goes bankrupt overnight, you know what your losses are going to be. Let's take a look at a real-world in-the-money covered call example. This was from the close of business today. I chose this one for a specific reason that you'll see in a little bit. We're going to look at Sears Holding, stock symbol SHLD. As I mentioned before, I'm just going to reiterate it. This is not a recommendation to buy Sears Holding, sell the December 60 call. This is just an example for tonight's presentation. Again, I am not a financial advisor. I am not a broker. I am an educator. So, at the close of business today, we could buy 100 shares of SHLD at $66.89 per share. At the same time, we can sell one December 60 call, sell one contract. We do 100 shares, we're going to sell one contract for $8.50. We collect $8.50 of premium. And we are roughly $6.90 in the money. We bought stock at $66.89. We're entering into an agreement to sell our shares of stock at $60 at December expiration, unless we choose to manage it, but that's our obligation. We're going to collect $8.50 for that right. So this makes the total cost basis of our position $58.39. $689 minus $850, we've got $58.39 essentially totally invested into this position. My maximum profit if assigned. If the stock stays anywhere above $60 by December expiration, and my choice is to let it get assigned, we'll make $1.61 in profit. That's the time value. Remember, we're giving up $6.90 roughly of intrinsic value, so the $1.60 or $1.61 of time value is our profit, which translates into about 2.8%. Now, the downside protection here is 12.7%. That means the stock can drop 12.7% from its current value before we hit our net debit or break-even point. And our maximum risk is 100% of the investment, $58.39. That's in the severe case. If Sears Holding goes bankrupt overnight, our stop losses would get violated, and then we'd be totally out that $5,839 from purchasing 100 shares. Okay? Now, let's just take a look at a stock chart. You know what this is going to look like. If the stock's trading above $60 per share, we get assigned. If the stock goes up to $80 to $90 to $100 per share, we can't make any more profit unless we roll the call and do some management. Assuming we just let it get assigned, we can't make any higher profit than that 2.8%. Our break-even point here, that's that $58.39. Remember, we're gonna come back to this in a few minutes. But remember, that's $58.39. If the stock's trading below $58.39 at expiration, let's say it's trading at $58, what happens? Our call expires worthless. We keep the stock in the premium, but essentially we have an unrealized 39 cents lost. Our cost basis was lowered to $58.39. It's currently trading at $58 per share. We're basically down 39 cents. And if it really falls, or if it falls overnight and it breaks through our stop losses or any other things that we have there, we might have a more significant loss as well. Okay? Now, the at-the-money covered calls, the common objective here is just to collect a higher time value. The at-the-money options in any chain, the options that are currently trading at the strike price, will always have the highest time premium. As covered call investors and naked put investors, that's where the most juice is. Okay? The time value is equal to the profit. Now, as an at-the-money covered call trader, I may be doing one of two things. I may be hoping that the stock moves up and I'll get assigned and have a nice return because I collected a higher time premium. I may actually be expecting the stock to remain stagnant and not move at all so that I can buy to close that call or have it expire worthless and still keep a lot of the initial premium I received. It depends on what my goals are. The risks are essentially the same. I don't even know why I copied it on this slide, but the risks are the same as we saw before. Similar to stock ownership, can suffer significant losses if there's a plummet, even if we're using stop losses. Okay, our cost basis is reduced, and we're still at risk. Let's take a look briefly at what an at-the-money covered call would look like. Let's say we're looking at Coach, COH. buy 100 shares right now at $33.96. Let's just say close enough to 34. Sell the December 34 call for $1.80. This gives us a total cost basis of $32.16. The stock price minus the premium we receive, we're at $32.16. If we're assigned at 34, the maximum profit will be $1.84, or 5.7%, a little bit higher than that potential 2.8% return we were looking at for Sears Holding that was in the money. But our downside protection for an at-the-money call is going to be lowered. It's only going to be around 5.3%. Again, the risk is still 100% of the invested amount. Want to take a look at a profit and loss chart? It's very similar to what we just saw, little upside-down hockey stick graph here. Our current stock price is right at the strike price, so we essentially have a 50-50 chance of getting assigned at expiration or not getting assigned at expiration, depending what our goal is. But we're going to receive a much higher profit because we've got a little bit more juice in the time frame. Even though we're looking at a different stock, we're getting a little bit more juice on those positions. Okay? Out of the money, what we saw in that chain, we're going to collect a smaller premium. We can have two objectives here. I've done this both ways with an out-of-the-money call, covered call position. One is, I like the stock. I'm planning on holding it for a long time. I sell the out-of-the-money call in the expectation that the stock's going to remain around the same price or move up a little bit. My goal is potentially to collect a dividend-like income on a month-by-month basis. Now, the problem with this, of course, I'm only collecting a small premium, so if the stock drops, I'm going to be in a little bit of trouble. I didn't collect much to lower my cost basis. I might be actually speculating on the position. Now, even though covered calls are not considered a speculative position, usually that term's referred to things such as long calls, long puts, or long straddles, or long strangles. But I really look at this as a speculative trade in the sense that I sold an out-of-the-money call. I'm expecting the stock to rise because I'm going to try to lock in that much higher profit, even though I have a lower probability of even seeing that. Again, the risks, low premium means low downside, still at risk for about 100% of the total invested. And it may take a long time to really effectively lower our cost base if we're just collecting 40 or 50 cents on a month-by-month basis. Okay? One example, Advanced Auto Parts, currently trading at $37.72. We could sell the out-of-the-money December 40 call for about 90 cents. This would reduce our cost basis down to $36.82, about $1. It's not great, but it's not bad. Now, the maximum profit if I'm assigned would be $3.18 because, remember, in order to get assigned, I have to have the stock trading above $40 per share. My cost basis was $36.82, so there's our $3.18 profit, or a potential 8.6% if assigned. Downside protection of 2.4%, not that much. Stock can only drop 2.4% before I'm at break even. Again, maximum risk, 100% of what's invested. And you have a wider sort of range here. Our strike price and our maximum profit is well above or just above the current stock price. Current stock price is the green line there. Break even, didn't lower it that much. That's the purple line there. And then so we have our profit and loss chart. We can make 8.6% if the stock moves above 40 at expiration, but we have a low chance of getting that. Okay. Oh, didn't want to move the arrow there, but let's just adjust that. Now, let's get into why we're mostly here. What is parity? Well, typically, generally in the dictionary, parity is defined as equality, as in amount, status, or character. It's an equal thing, things that are equal to one another in amount, character, or status. Equivalence, correspondence, similarity can be used as an analogy, the parity between two things that are essentially equal. For options investors, we know that every option strategy has at least one parity trade where the risk-reward profile is similar at the time the trade is entered. Now, I say at least one because there are some positions that have multiple parity trades. For example, last week during our strategy discussion, we talked about the vertical spreads, looking at bull put credit spreads, bear call credit spreads, and their parity debit spreads. Well, the bull call debit spread is a parity trade to the bull put credit spread, which is also a parity trade to a standard collar. And then a bear call credit spread is a parity trade to a bear put debit spread, which is also a parity trade to a bearish collar position or a short collar. So there are positions that have multiple parity trades that can be, the risk-reward profile can be mimicked synthetically. Now, analyzing parity for covered calls and naked puts. Let's start on the left here. Covered call trade, what we just reviewed. The max profit is earned if the stock is above the strike price at expiration. And we saw that, for example, with the in the money, at the money, and out of the money calls. We make that maximum percent if assigned, the most we can make on the position, when the stock is trading above the strike price of the call option. Well, for a naked put trade, the maximum profit is achieved if the stock's trading above the put strike price. Still a neutral to bullish position. Okay? For a covered call trade, the percent if assigned, which occurs when the stock's trading above the strike price and we're assigned at expiration and deliver our shares of stock, the percent if assigned is our maximum return. For a naked put, what's referred to as the percent naked yield is the maximum return, which again is earned when the stock is trading above the strike price of the put option. When I sell a covered call against my stock position, the premium I receive lowers my cost basis. When I sell a naked put against a stock, which I don't own shares of stock, the premium lowers the cost basis if I'm assigned. I'm only assigned on the naked put trade if the stock falls, goes the opposite direction, and is trading below the put strike at expiration. Both positions still have a very large risk if the stock falls in price. Okay, we're still obligated to have the full amount, the full monetary requirement at risk. All right? Now, reasons to compare. Well, quite simply, one trade may offer a better risk reward than the other. This can happen in the credit spreads and debit spreads. This can happen with the collars compared to the credit and debit spreads, and this can happen to a covered call trade compared to its parity naked put trade. It happens when the calls are overpriced or the puts are overpriced for the same stock. Similar trade, similar risk-reward profile, different potential profits. We always want to make sure that we're getting the most bang for our buck as option sellers, don't we? So before we enter a covered call trade, it never hurts to compare it to the naked put trade to see if there's a better potential premium. And reverse, if I'm a naked put seller by nature and I only do covered calls occasionally, before I enter that naked put trade, I'm going to compare it to the covered call just to see if there's a little difference. Okay? So here are the position that we saw before on the left. This was our profit and loss chart. I don't have the numbers here, but I'm going to show them in a minute. Here is our profit and loss chart for Sears Holding for a covered call. Remember, the max profit we could make on that position was $1.65. It shows us here the max line at $2.25. It's just under that at $1.65. Over here on the right, I have the out-of-the-money naked put position for Sears Holding. Well, wait a minute. Same exact risk-reward profile, upside-down hockey stick. My break-even is almost the same in each case. It's here, remember, our break-even was at about $55.89. This one looks to be a little bit lower, doesn't it? Which works in our favor because we're neutral to bullish on the stock potentially. But the maximum profit is higher. Graphs look exactly the same, but the maximum profit is higher. Why is that, and how much higher is it? The out-of-the-money naked put objectives are the same as if I'm doing an in-the-money covered call. When I sell an out-of-the-money naked put, I want to have my put expire worthless. The stock remains above the strike price. My maximum profit is equal to the premium that I receive. I can take the profits, then enter a new out-of-the-money position for the next month. So at December expiration, my put expires. I keep the premium. Maybe I'll sell a January put at the 60 strike or a different strike. Or I could roll the position month by month. Now, the risks are similar to regular stock ownership. I don't own stock, but I can suffer significant losses if the stock plummets. When we did a covered call, we bought the stock, we sold the call. Selling the call obligates us to deliver shares of stock at that price if the stock's trading above it. When I sell a put, I'm going to be obligated to buy shares of stock if the stock's trading below the put strike price. As the stock falls, the investor on the other side, the put buyer, is going to force me to buy their shares of stock at that put strike price. So I still have the essential risk on the downside. The premium does reduce some of that cost basis, but we're still at risk for the capital invested. Let's take a look at the out-of-the-money parity trade for Sears Holding. Remember, we were looking at the in-the-money covered call of buying shares of stock of Sears Holding and selling the 60 strike call, the in-the-money covered call. The parity trade is the out-of-the-money 60 strike naked put. Okay? Remember, I sell the 60 call. I'm obligated to deliver my shares of stock at 60. If the stock's above 60, I make the maximum profit. If it drops below my break-even price, which is around $58.39, then I start to lose. Same feature here. I can sell the December 60 put. It's out of the money for $275. Now the margin requirement is going to be $60 per share. And I'm going to pause here and just discuss something. Whenever I'm referring to naked puts in this presentation, I'm only referring to cash-secured naked puts. Yes, you can trade puts on margin. You can use only part of the requirement. Why is my requirement 60? Because my broker is going to see that if the stock falls below 60, I'm going to be required to buy 100 shares at $60 per share. I'd need $6,000 on hold in my account to place the trade. But if that happened, if the stock dropped to 59 and I let the stock be put to me at 60, I still keep the $275 premium, so my cost basis is $57.25. This is slightly lower, isn't it, than that in-the-money covered call. The in-the-money covered call gave us a cost basis of $58.39. My maximum profit is $275, or 4.8% of my requirement. The percent to break even, this is how far the stock needs to fall from its current price, which is $60. Okay, I'm sorry, $60 to the cost basis of $57.25. So I have a 15% to break even. Now, I'm still at risk, though, for roughly 100% of my total investment, which in this case would be the $57.25. If I was forced to buy shares of stock at $57.25, I let the position get against me and the stock was trading at $3, I've essentially lost $54.25, haven't I? Okay, so very similar. We just saw the risk-reward profile. Here it is again. Our maximum profit is $2.75. We sold the out-of-the-money 60-strike naked put. How is that in comparison to our initial in-the-money covered call for Sears Holding? Well, for Sears Holding, is there an advantage or not? Well, the covered call gave us a max profit of $1.61. The parity trade of the 60-strike out-of-the-money naked put was $2.75. My monetary requirement, stock that I had to pay, was at $66.89 minus the $8.50 I received. My monetary requirement for the covered call was $58.39. For the naked put, if I had the stock put to me, technically my cost basis would only be $57.25. My maximum return on the covered call position, if the stock remains above $60 at expiration, was 2.8%. My potential yield for the naked put on Sears Holding is 4.8%. Compare the downside protection. Remember, on the covered call, the downside protection was how far the stock needed to drop or could drop before we hit the break-even price. That was 12.7%. For my naked put, the percent to break even, or how far the stock could drop before I met the break-even, is at 15%. I'm collecting a higher premium, higher time value, which gives me a higher yield, higher protection, but the probabilities are exactly the same. We're looking at the same strike call and the same strike put. So for Sears Holdings, there's a 69.6% theoretical chance that the stock will remain above $60 at December expiration. Well, that's the same for the put, isn't it? The probability above for the call or for the put doesn't change. There's still a 69.6% chance, theoretically, that Sears Holding will remain above 60 at December expiration. And remember, that's what we want to have happen with both of these positions. Our maximum return is earned when the stock is trading above our strike price. In this case, there is an advantage to doing the naked put over the standard covered call position. Okay? Now, you want to always compare with caution. And we're going to look at the other two trades as well, because I believe that the other two trades, we're going to see the reverse. We're going to see that the covered call trade is actually better than the naked put. I always chose Sears Holding because I don't know why, but for the past several months, I've noticed the implied volatility on the puts for Sears Holding is always much higher than the calls. That's why there's a disparity there on that Sears Holding position. Now, always compare with caution, and comparing the risk-reward values is where you want to start. So for the covered call, our maximum return is the percent if assigned. Our reward is the percent if assigned. So I'll compare the covered call return if assigned to the naked put percent naked yield. For the covered call, I'm going to look at the downside protection. That's my sort of risk tolerance, or my risk protection, how far the stock can drop before I start losing money on the position. For the covered call, it's the downside protection, and we'd compare that to the naked put percent to break even. look for a disparity between the values. You have a higher naked yield on the put option compared to its parity percent if assigned. For Sears Holdings we did, didn't we? Was the percent to break even for the naked put higher than the downside protection for the covered call? Of course, yes it was, because we received a much higher premium. Now, this is not always the case. Let's link back now to the PowerOptions suite of tools. Remember, we were looking at the December option chain for Apple there. And what I'm going to do now is I'm going to go to the My Portfolio tools. This is where you can track and paper trade current positions or positions that you're interested in trading in the profit and loss portfolio. Okay, so I'm going to go ahead and pull that up. And what we're going to see here is the different trades for our positions. Remember, I showed the comparison of the at-the-money Coach covered call position. Here's Coach, bought at $33.96. We went ahead and theoretically sold the December 34 call for $1.80. Okay, well, how did that look on our profit and loss chart? Remember? Let's just take a look. I'll go right from this portfolio here. I'm going to pull up the original profit and loss chart on my position. For Coach, the at-the-money, remember this is our at-the-money covered call position. Here's our profit and loss chart again. The maximum return is 5.7%. Remember, this occurs if the stock's trading, in this case, above $34 per share, and we'll get assigned to earn the maximum return of 5.7%. We paid $33.96 for our stock position, and we're going to collect $1.80 in premium for selling the 34 strike call. Okay, it's 4 cents out of the money, but you know that's close enough to at the money for our results. Okay, so this gave us a 5.7 potential return if assigned if the stock's trading above 34. This also works out to be about a 5.3% downside protection. This is for the at-the-money covered call on Coach. Okay, well, let's close this profit and loss chart and compare it now to the at-the-money naked put for Coach. Here's the December 34 put option with a natural bid price at today's close was $1.90. So let's go ahead and take a look at our profit and loss chart and compare it to that position. Okay, this one actually works out to be very similar. It's an slightly in the money put option. We're 4 cents in the money, and we're going to collect $1.90 in premium. Remember, the Coach slightly in the money call was only trading for $1.80, so we're going to get about 10 cents more for doing this potential put. So that would give us roughly a 5.9% naked yield for selling the naked put, the 34 strike put for December. At the same time, we also realize that if our percent return is higher, our percent to break even is going to be slightly higher as well. It's going to be around 5.4%. The stock can now drop 5.4% before we're losing money on the position. Our total monetary requirement in this case would be about $32.10, slightly lower than what our monetary requirement was for the at-the-money covered call position. So there's a little bit of an advantage here. Another advantage that's kind of reflected in this one. So you'd say, okay, well, I'm planning on doing the covered call, 5.7% return versus 5.9% return. Maximum profit of about $1.90 compared to maximum profit of about $1.80 or so. Not much difference. One other thing to consider, depending how your commission costs are and how many shares or contracts you're doing. If I'm doing a covered call trade, I might have to pay a commission cost to buy the stock and to sell the call option. But with doing a naked put, I only have to pay one commission, paying one commission to sell that contract. So if I'm doing a smaller amount of contracts, that's another thing to consider. The naked put might give you a little bit more benefit if you're only doing, let's say, 100 shares in one contract, because you have to pay 2 contracts potentially to enter the covered call, depending on your broker, whereas a naked put, you'd only have to enter 1 contract. All right, let's close this one. Let's do our last comparison there. Remember, Advanced Auto Parts, currently trading at close of business today at $37.72 per share. We could sell the December 40 call for about 90 cents. All right, let's link from our portfolio tool, go to Position Actions again, into the profit and loss chart for Advanced Auto Parts. That maximum return, remember, was 8.6%. We received 90 cents against a cost basis of $37.72. So that gives us a break even of about 2.4%. Okay, the downside protection, this is the covered call. Our downside protection was only 2.4%, and we can potentially make 8.6% if the stock is trading above $40 at December expiration. All right, let's go ahead and close that down. We know that here's our December 40 naked put position. December 40 put, roughly selling at about 320. Wow, that looks much higher, doesn't it? We only collected 90 cents in premium for the for our out of the money covered call there. So this should be much higher because we received 320. But what's the difference? Remember when we looked at the in the money covered call, we sold a call that was below the strike price. We collected a high premium because we collected both intrinsic value and time value. Well, compared to the out of the money put, parity trade for the Sears 60 strike put, that 275 was all time premium. There was no intrinsic value. The 90 cents I received here for the out of the money December 40 call, that's all time premium, but the December 40 put is $2.28 in the money. It's trading at $40 per share. We had an out of the money call, covered call position. This is now an in the money naked put position, which I would never recommend that you do. The reason why is because if you sell an in-the-money put, typically we see early assignment much faster. Now that might not be too bad if it gives you the return that you want, but this 320 is an all-time premium. It's $2.28 or so of intrinsic value, pretty much close to 90 cents a time premium. But hey, let's see how it looks like on that profit and loss chart, shall we? So we can compare it to our in-the-money or out-of-the-money covered call position. Here again, we see a slight difference. That's kind of neat. We've got an 8.7% return of naked yield if we sold this put, and our percent to break even, remember we're collecting 320, but we're not going to compare the 320 against the stock trading at 32.27. Well, remember, most of that is intrinsic value. If we were forced to buy the stock, we'd be forced to buy at $40. So we want to look at the percentage to break even there as the $3.20 compared to our $40 strike price. So in this case, it works out just to be the same. We have about the same percentage naked yield as we did to the percent return on the out-of-the-money covered call, but remember, in both situations, we have a very low probability of the stock moving up and achieving that return. Okay, let's do something unique here. First person who uses the question pod to send me a stock symbol wins. I don't know what you're going to win yet. You might win a free naked put book. You might win your choice of a free naked put book written by Ernie and myself, or the Protective Options Strategies book. All right. Okay, got the first one. Leo, first one in is IBM. Sorry, guys. Thank you all for answering, though, but the first one in was IBM. Let's go ahead and take a look here at the chain. What I'm going to do is go to the 5-strike call and put chain for IBM, and what I'm going to do is go to December again. We're just going to ignore November because it's too short of a time frame left. Now, what I'm comparing here on the standard chain, just by typing the symbol into the top, we're comparing here the covered call, the call and the put chain for IBM December expiration. Now, as we saw earlier, we have our important features selected here already. Here's the downside protection for our 5-strike call chain. Over here on the left is our call chain. Here's our percent if assigned. I don't have the probability selected. And over here are our puts. On the right-hand side, here's our puts. We have the percent to break even selected, but I don't see the naked yield. So what we want to do is when you're comparing covered calls and naked puts, you can use this chain to quickly do that. Let's change some of these columns. I'm going to go into the See More or Less columns field. This allows me to customize what I'm viewing in the field. And let's just look at the important things that we'd want to see. Well, for my call info, I want to see the strike price. I want to see the call symbol, the option bid and the option ask. Volume and open interest right now, not going to worry about that. I am going to leave the implied volatility. I'm going to show why in just one second. As a covered call trader in the call chain here, I'm going to want to see that downside protection. I'm going to want to see the percent if assigned. I'll leave the percent in or out of the money. That'll be okay. But what I also want to see here is the percent or the probability above as a covered call trader. For the put side, on the right, well, when I'm looking at doing a naked put, I'm going to be comparing the same thing. So I'll leave the put symbol, the option bid, and the option ask. For now, volume and open interest I'll remove. I'm going to leave implied volatility. The downside protection, well, we, remember, don't look at downside protection when trading naked puts. We're going to look at the percent to break even, which is selected. And the really important one is that percent naked yield. And I, of course, am also going to look at the probability above. They're going to be the same. We know that, but I'm going to go ahead and do that anyway. Okay? So let's go ahead and click Save and Return. I'm going to close the window, and it's going to refresh the chain for us. It's going to look a little bit more simple, and it's going to help us do the comparisons that we want. I should have moved the percent naked yield, but that's okay for right now. So for IBM, currently trading at 123.10, let's run our comparison. Let's say we're going to do the slightly in the money covered call. We're interested in selling the 120 strike call, buy stock at 123, sell the 120 call, roughly receive $5.15 of premium. I know this is a relatively low volatile stock, so we'd get 4.2% downside protection and not a very high percentage if assigned, only 1.7%. Now, of course, we're going to have excuse me, a 64% probability of getting assigned and earning that return. Now, in comparison, if I sold the 120 strike put, we'd receive about $2.67. This is another one where the put's higher. Maybe recently because of fear or anticipation in the market, the puts are overvalued. 2.2% naked yield, 4.8% to break even. Here's another one where that comparison would work better for the put. All right, I believe it's Steve sent in a stock here, NTES. I'm going to take a look at that one. Let's run that same comparison again. Let's see which one might be better. And I'm just comparing the sort of at the money, slightly in the money one each time. Okay, here's our December chain again. NTES currently trading at about $39.62. Let's just take the slightly in the money 39 call. Okay, buy shares of stock at $39.62. Sell the 39 call for $3. 7.6% downside protection. That's pretty good. 6.5% potential return. Hey, that's pretty good too. But the comparison, the parity trade, the 39 put, again, wow, this one looks a little higher, doesn't it? $2.45 of time premium, which would give an 8.3% break even, percent to break even, or 6.3% naked yield. In this case, it's interesting. The percent to break even's higher than the downside protection due to the fact that we're 62 cents in the money on the call and 62 cents out of the money on the put. So the stock would need to drop 62 cents plus an additional 245 before we hit break even. But in this case, the percent naked yield is a little bit lower than that percent if assigned. So you might want to, this one might be a good candidate where you might want to think that the covered call is greater, is better than the naked put. All right, a couple more here. Let me just do AZO. You kind of get the idea of what we're doing. Maybe I'll just do one or two more. I saw AZO come in. Go ahead and hit submit there. AZO at AutoZone 140.21. Hey, this is good. This is a good right at the money example. Stock's at $140.21. If I bought this stock today and sold the 140 call, we'd receive about $5.40 in premium. 3.9% downside protection, or about a 3.8% if assigned. That's pretty good. But hey, in comparison again, there's that 140 put, 4% to break even, a little higher, and a 3.7% naked yield, almost as good. So those of you who are currently on your Power Options trial, what you'll be able to do is run this chain, select the various columns there. Remember, we talked about what you want to do. You want to compare the percent downside protection and the percent if assigned to the percent to break even on the naked put, to the percentage naked yields and the percentage to break even. And this will give you a comparison of which one might be best for you. Let's wrap up a little bit here. Sorry I didn't get into all those stocks there. Leo, as you mentioned, very quick fingers. Good job. Back to always comparing with caution. Some of the disadvantages I mentioned earlier about one of the advantages of naked puts is, well, no stock is owned, but you still want to make sure that you're doing cash secured, or if you're doing these naked puts on margin, that you're really aware of the risk-reward tolerance, okay? I don't recommend trading naked puts on margin. I always recommend being cash secured. But one of the advantages we talked about was that the naked put, we don't own stock, and it's only one commission. The disadvantages I feel about doing naked puts over covered calls is that first, may require a higher approval with your broker. Okay? Level 1 trade, and you might not even be allowed to trade it. And what I mean by that is that there's some brokers out there for certain IRA accounts and sheltered accounts that will not allow you to trade naked puts in those IRAs. A lot of the more advanced online options brokers, Options Express, Thinkorswim, I believe, Trade King possibly, the new one that's out, Trade Monster now, Interactive Brokers, they'll probably allow you to trade naked puts in your IRA or your tax-sheltered account. But some of those are the, excuse me, other places such as maybe E-Trade or Fidelity might not let you apply to even trade naked puts in that account. So you might need a higher approval. You might need to have more trades under your belt or have a certain level of, a certain monetary value in your account in order to be approved. Now, if I'm trading an in-the-money covered call, I'm going month to month to, doing in-the-money covered calls month by month to get assigned and earn that return. What might happen here is that if there's a dividend paid, I won't collect the dividend with a naked put. But really, if I'm doing in-the-money calls and I'm just going into new positions month by month to earn that 2.5% or 3%, really not expecting to collect a dividend anyway, it's nice if I'm in the stock during that time period from the ex-dividend date to when the dividend is paid, but it's not necessary. I'm more focused on having a high probability of getting that 2 or 2.5%, 3% return. Okay. An actual advantage of the naked put is that no stock is owned, but this can also be a disadvantage if no stock is owned. If I'm in a covered call position and the stock starts to rise due to some anticipated event and it really, preparing to take off, or I have a feeling it's going to take off, I can pay a little bit extra to close the call, cancel my obligation, and then when the stock takes off, I can have the further upside, or I can, keep selling calls above that. Now, with the naked put, if the stock rises, I can buy to close my put for a cheaper price and then sell to close a higher strike put, but I don't own the stock. If the stock really takes off, then I'm just moving up in giant leaps by rolling the put up to a higher strike price. I'd probably have a better overall profit if I rode the stock all the way up. That's an extreme example if the stock just takes off and you're able to close the call before that happens compared to the put, but it can be a disadvantage because the naked put, you don't actually own the stock, and even if you close your obligation, you've got to sell a put at a higher premium. But if it keeps going, okay, you just keep buying your put back and going up. You'll be making small profits, but if it's going up at $10, $20 at a time, if you manage to cancel that call and ride the stock up, you have a much better potential profit. Now, what to look for? Well, this is something we discussed in the vertical spreads and in the collars. You can use the default searches on PowerOptions in the covered call and naked put as a guide. Those aren't recommendations. You want to use the default searches we have set up for you as a stepping stone to create your own personal search. Okay? You can adjust your stock criteria to be bullish or bullish to neutral, or however you are looking to enter positions. If you do want dividend-paying stocks that have good earnings per share, price to earnings, you can put that into the system to find only those covered calls or naked puts that match what you're looking for. Make sure that the position matches your risk-reward tolerance. Never trade solely for premium. One of the things, I'm going to talk about that in a minute, but never trade solely for premium. Only trade positions you're comfortable trading. What I mean by that is, I like this covered call trade I just found on stock XYZ. Following the guidelines that I discussed tonight, I'm going to go ahead and compare it to the naked put. Well, I see I can make a little bit more premium with the naked put, but you know what? If you're not totally familiar with naked puts, you haven't really traded them in the past, you're not sure if you're comfortable with it, even though it's offering a slightly higher premium, don't do it. If the covered call matched your risk-reward tolerance, matched the goal you want, stay with that trade, get educated more on the naked puts, and get more comfortable with them before placing the trade. But just trade what you're comfortable trading. Don't try to overtrade. Don't trade solely for the highest premium. That can get you into a lot of trouble. Further detailed information. We have a covered call course. This covered call course includes a book, DVD, and a workbook. And it's Covered Calls, Aggressive Strategy for the Conservative Investor. This is written by Ernie and Greg Serenner. The cost of this product is $199.95. It goes through Ernie and Greg's philosophies of covered call trading and, of course, showcases a lot of the PowerOptions tools and how to use them as well. Now, the cost, as I mentioned, is $199.95 plus shipping, but with the purchase of the covered call course, you'll receive 2 free months of PowerOptions. So it's basically $160 because the 20-minute delayed service on PowerOptions is only $59.95 per month. But you'll receive 2 free months of PowerOptions when you purchase the course, so you're really getting all that information for only about $30 or $40. You pay $200, get 2 free months of PowerOptions valued at about, say, $120, $160 there. It looks pretty good, doesn't it? For naked put traders, I'd mentioned this earlier. In this book is a good description, but the full details of how Ernie and I approach naked put trading and how to use the PowerOptions tools for naked puts are described in this book. It's very low cost, only about $14. It's loaded with information. You can find this in the Power Store at PowerOptions, or just give us a call or send us an email if you're interested in ordering that book. One thing that I found very unique when we were doing the research for this book is Ernie and I ran 2 different comparisons on naked puts. We talked about the criteria that we use. Okay, we look for stocks that have good earnings per share, good price to earnings, stocks that are trading in an uptrend, and things that we look for quality growth stocks. Well, we ran some historical searches over about a year of assuming that we did no income methods on those positions. We applied no management to those positions. At the end, that return worked out to be a total of about 1.5% on average per month, which is pretty good. That was a little bit less than that. I'm sorry. It was about 0.8% per month. I apologize. And we had some losses. I think the average win-loss ratio was around 70 to 75%. This, again, was assuming no management, just, hey, we entered the 6 trades that matched this month. How did they do at expiration? Okay, we had 5 winners and 1 got put to us for a loss. Okay, let's just roll to the next month, not even manage it. That's what we looked at. It was a pretty good win-loss ratio and a pretty good return. But we compared that to doing a more moderate style of looking for at-the-money naked puts and an aggressive style of looking for naked puts that had a really high time premium because really inflated implied volatility. The really high time premium, high implied volatility one of the scans that we showed pulled up a few stocks at the time we wrote the book of Indy Bank Corp. I believe Indy Bank Corp was around $11 at the time. You could sell the just out of the money 10-strike put for almost $2.50. Okay, 6 months later, Indy Bank Corp was bankrupt. There was another position there that was, of course, a pharmaceutical. The month after we found that trade, it offered a premium of around $1.50, $1.25. Within 30 days or 15 days after opening that position, the stock dropped about 89% because it failed an FDA approval. So that's what I was saying by don't be lured in by the premium. If you look for naked puts just with the highest premium because of high implied volatility or even covered calls, you're stepping almost into a bear trap. It carries a lot of risk with it. Okay. Now, one thing that we saw, of course, with the covered call tradings, the risk on the downside, sure, you can use stop losses, but I'm sure we've all been violated by stop losses in the past. Naked put has that same type of action. A methodology that may interest those of you who are more interested in protecting your capital but still having unlimited upside profit potential, sort of our sister site, Radioactive Trading, that was developed by Kurt Frankenberg. He's got a book there called The Blueprint. It's a full trading methodology of using a unique form of married puts and then launching 10 different income methods off of that. This sort of solves the problem of the risk related with covered calls and naked puts. The full methodology blueprint there is $289 plus shipping, but it has the potential to save you thousands more than that by protecting your positions and then focusing on the return later. And if that sounds interesting to you, please feel free to join us. Every Tuesday and Thursday at noon, Kurt and I host an introductory webinar to the radioactive trading methodology. So every Tuesday and Thursday at noon Eastern Time, we'll do an introduction there. But the blueprint, full methodology for protecting your positions first, limiting your risks on stocks that you're bullish on, and then applying 10 different income methods later to cancel your risk and still have unlimited upside profit potential. Now, I had mentioned this a little bit earlier, the PowerOptions subscription services, those tools that we were looking at tonight. 20-minute delayed service is only about $60 per month, $59.95 per month. It gives you access to all the tools and all 23 different strategies for only about $60 per month. We do offer a discounted annual price of $600 for the year. So you're essentially paying for 10 months but getting 12 months of service. We also offer a real-time service. It's about $80 per month, $79.90 per month, and then a discounted rate for $800. This gives you access again to all the tools on the tool menu for all 23 strategies, but with real-time prices instead of 20 minutes late. They're not streaming real-time, but every time you run a search, refresh the page. You can literally refresh the page every second if you want to. You're just going to be getting the numbers at that instant. Now, there's a historical data as well. This is an additional cost on top of these two subscriptions. You can sign up for a quarterly subscription to the historical data for about $99.95 for 3 months. But if you're on the real time and you're interested in looking at that historical data, it's just easier to upgrade to the professional level of service. It's only $20 more per month. Adding the historical data here quarterly would work out to be about $33 per month. So if you're only on the real time, it just makes sense to go to the professional, $99.99 per month, or a discounted rate of $1,000 per year. Questions? Many of you know, of course, you can contact us at any time. I'm still going to stay online for a little bit, so if you guys have questions, go ahead and send them in, and I'll be I'll answer some of your questions. But you can email us at any time to support@powerop.com. Call us toll-free at 877-992-7971. That's if you live inside the continental United States. Or you can reach us if you live outside the continental U.S. at 302-992-7971. There's also contact links on every Power Options page. I apologize for this. Look for the caller presentation. That was when in the Power Forum section, we created a thread for the caller presentation we did a few weeks ago. I just want to remind everyone, of course, you can go onto that Power Forum section if you're a trial or subscriber member to Power Options there, and you can read the threads of different users, subscribers, and trial members for Power Options, both the tools and the different strategies. Okay. Richard asked a question. He unfortunately signed in late, so he wants to know if this was recorded. Yes, Richard, I am recording this presentation, I believe. Yes, I am recording this presentation. I apologize. It most likely will be available in our webinars archive page, probably maybe Monday afternoon or Tuesday morning. Okay, so we have to do some processing on this, have to do some changes to different formats, so that should be available. I'm sorry, Monday evening or Tuesday afternoon. All right, so let's see. Got some other questions coming in here. Let me just scroll through these. I'm just going to make sure I have some information here from Leo. I think Ernie already took care of that, but I just want to be positive. All right, let's just go ahead and go through that there. Okay. Okay, all right. Looks like got a question in here from Lindsay. You own stock. Is covered calls the only way for me to receive an income from owning the stock? Lindsay, absolutely not. There are a variety of ways that you can take income from a stock position. There's also a very important way that you can have stock and add protection to that position so you're not risking more than single-digit amounts if the stock falls against you, and then launch 10 different income methods off of it to generate income and pay for your risk. You'll find that information at radioactivetrading.com. But what I'd suggest, Lindsay, is that sometime later this week, if you get a chance, I know it might be scheduled up on Friday, but sometime next week, why don't you go ahead and give me a call at the office or send me an email. We can set up a time to talk. You can potentially do other things on a stock that you own. If you're still neutral to bullish on it in the next 30 or 40 days, you might be able to do a bull put credit spread instead. That'll increase your risk on the position. Okay, but you still could do that to generate some income. There are ways that you can sell a put. You can sell a naked put against the stock that you own. The stock doesn't cover the put obligation, but if the stock moves up, the put will expire worthless. You kind of generate an income in that way too. But I think a better approach, Lindsay, is if you own stock and you want to work the position, generate some income, we want to talk about that unique form of radioactive trading, using those unique married puts to have a limited risk on the position, but then launch 10. There are 10 different ways you can generate income off of that position once you have the protection in place. So if you can tomorrow, give me a call or send me an email. If you're not available tomorrow, give me a call next week, Lindsay, and we'll talk about some of those ways that, other than covered calls, and even better ways that you can generate income off of your positions and still take advantage of bullish positions. All right, Leo, thank you for joining me too. I think Ernie got all of your information and you're all set there, so that's good. Glad to see you here this evening. Lindsay, you're very welcome. I hope to hear from you soon. You guys have any other questions? I think I've answered most of them here. If you have any other questions, go ahead and send them my way. I'll still be here for a few moments, and I'll answer any other questions that you guys want to ask me about the discussion we had this evening, or the excuse me, the parity trades, of course, or the tools on power options. Another thing I wanted to remind you, those of you that are currently on your 14-day free trial, if you subscribe to Power Options before the end of your 14-day free trial, you will receive an additional 14 days for free. So have use of Power Options for 1 full month before you're technically billed for the service. Anyone who's on a trial, anyone who's on a trial or subscribers, always remember that you can sign up for those free coaching sessions. It's not singular, it's actually plural. The free coaching sessions, there's essentially a 35 to 45-minute phone conversation with either myself or Ernie. We'll answer any of your questions, walk you through the tools on the site, get you better acquainted with the tools, the risk-reward profile of some of the strategies that you're looking at as well. So as a trial member or as a subscriber, you want to make sure that you take advantage of those coaching sessions. Oh, and a lot of you received that email today, and that's why you joined us, about the upcoming other presentations we're doing on the Power Options site right now, and also I believe on Radioactive Trading. If you wanted to join us tomorrow at 4:30, we're having an open discussion. Essentially what this is, it's about an hour to hour and a half presentation. I'm online. I sit back. I have no material to present. I just let you guys ask me questions. You can attend and not ask any questions, but it's really geared by the questions that customers ask, and I just essentially go through and answer the questions, showcase the tools on the site. So it's completely free. Come join us tomorrow at 4:30. Next Tuesday afternoon at noon, I was talking about that radioactive trading method. If anyone's interested in that and has not attended one of those webinars before, you can sign up to join Kurt and I Tuesday afternoon at 12 noon Eastern. There's also another presentation Thursday at noon Eastern on the radioactive trading method. It's a great way to protect your stock positions, still have unlimited upside profit potential, and you'll be introduced to some of the 10 ways that you can then generate income off of your limited risk positions. And there's a variety of other webinars that we host each week, so I hope to see you guys there. Well, I don't have any other questions coming in, ladies and gentlemen. Thank you so much for joining me. I hope to hear from you all very soon. Take care. Have a good night. Email us at any time. Give us a call. Happy trading. We'll see you soon. Good night.